This is Chandralekha Nair from Syngene Investor Relations team, and I welcome you to Syngene International earnings calls for fourth quarter and fiscal year 2018. To discuss our financial and business performance, outlook and address your queries, we have with us Mr. Jonathan Hunt, Syngene Chief Executive Officer and the senior management team. I hope you have gone through the results release and the quarterly investor presentation, which have been uploaded on our company website as well as stock exchange website. Before we proceed with this call, I would like to remind everybody that this call is being recorded and a replay will be available for the next few days immediately after the call. The transcript of this call will be made available in the next week's time on the company's website. I would also like to add that today's discussion may be forward-looking in nature and must be viewed in relation to the risks pertaining to our business. The safe harbor clause indicated in our investor presentation also applies to this conference. After the end of the call, in case you have any questions, please feel free to contact. Over to you, Jonathan.
Thanks, Chandra, and good afternoon, everyone. Thank you for taking the time to join our fiscal 2008 fourth quarter and full year earnings call. As usual, I'll start by covering the high-level financials highlights and then provide an overview of our business and operations before turning the call over to Mr. Chinappa, our CFO, who'll give you a more comprehensive update on the financials. As you can see from the press release, we had a strong finish to the year, and this, together with the good progress we made in earlier quarters, allowed full year 18 to recover from what was a little bit of a slow start to be a good year overall. We're particularly happy with the progress we made towards the end of the year in some of our key strategic areas for growth, and I'm thinking here really about the strong quarter we had with the biologics vertical. That said, we do want to spend a bit of time walking you through the impact of interest income, currency, and some one-off items in the P&L, as well as signpost to you the impact we expect at the PAT level, starting in FY19, from the unwinding of the SEZ tax holiday we benefit from in some parts of our business. But I'm going to leave Chinny really to cover that in his comments. On a reported basis, 4Q was a very positive quarter for Syngene, I think really due to two factors. The first, and probably the most important, was the good underlying growth across all of the business verticals. Secondly, there's the largely optical effect that you get from having a low prior year base. I'm sure you'll all recall that the fourth quarter 2017 was heavily impacted by the fire incident we'd had in the December of 2016. So looking at the financials, we reported 426 crore in revenue for the fourth quarter. That's a 35% jump over the corresponding period. EBITDA grew at 18% to 146 crore rupees, and at the PAT line, we recorded a growth of 8% and delivered 84 crore during the quarter. So margin performance was good. EBITDA at 34% and PAT at 20%. I think they're more in line with what we see as the type of margin performance we think of as normal over a full business cycle for Syngene. But if you compare that to the fourth quarter of FY17, both EBITDA and PAT margins were a little bit lower, and that reflects the decisions we made to step up our investments in business development, as well as increased investments in regulatory compliance and safety. And of course, we expect those investments to pay dividends in the future through better sales performance and, of course, a stronger organization. As I said earlier, strong Q4 numbers helps us post a full year growth of 17% in reported revenues. That's an increase of 10% in EBITDA and growth of 6% in the PAT line. And I'll leave Chinny to give you more flavour on the financials in his comments. So I will turn now to the operational highlights, firstly, of the quarter. A standout highlight of the quarter was the signing of the multi-year strategic research and development agreement with British drug giant GSK to provide drug discovery services. Discovery research has long been one of Syngene's core strengths, and the collaboration with GSK comes, I think, as a welcome recognition of Syngene's capabilities and expertise in conducting cutting-edge discovery research. Under the collaboration, Syngene will set up a customized discovery research laboratory for GSK, and within that, our scientists will work closely with GSK's
global R&D teams in identifying new drug candidates, and they'll do that across several therapeutic areas. We're also happy during the quarter to extend our collaboration with Merck KGaA. Syngene and Merck have been working jointly on a number of discovery research projects in the area of protein technology, molecular biology, cell science and antibody discovery since 1998, and the extension of the collaboration will enable us to work ever more closely with Merck's R&D teams on what we see as ever more complex problems and projects. The other event I'd call out was the accreditation of our manufacturing facility in Bangalore by the PMDA, the regulatory authority for the Japanese market. I think this is a significant achievement. The PMDA is considered by many to be the most stringent regulatory body in the world, and the PMDA audit was conducted in response to a regulatory filing by one of our clients to support their planned launch of a new product into the Japanese market. And as you'll recall, earlier in the year, we entered into a manufacturing agreement with them for commercial supply of that product, subject to its approval. Also during the quarter, the FDA issued a Form 483, followed an audit of our BABE facility. We've already submitted our response to the regulator, and at this stage really don't foresee any adverse impact on our operations stemming from that. And last thing in the quarter, on the people front, Dr. Anjan Chakrabarty joined us, was appointed as Vice President, Head of Discovery Research. He brings a wealth of experience in drug discovery, and I'm sure under his leadership, the discovery chemistry business will continue to go from strength to strength. So with that, let me turn to the full year highlights. So FY18 was marked by solid execution on a number of fronts. We added 23 new clients to our active client roster. That takes that to 316 active clients for the full year. Our strategic partnership with Amgen saw a scope expansion during the year. It'll see us work with Amgen closely on a wider range of scientific domains. And to deliver this, we're doubling our physical infrastructure and doubling our headcount that directly supports Amgen in delivering their growing R&D requirements. Similarly, Bristol Myers Squibb extended their collaboration agreement, extended it out to 2026, and also widened the scope of activities within that collaboration. Our work with Zoetis, and recall they're a global leader in animal health, was strengthened further with the signing of a multi-year manufacturing agreement. And I already alluded earlier to the multi-year manufacturing agreement with the Japanese specialty company. I think across the industry, biologics is gaining strong traction globally, and we consider it as our next long-term strategic growth driver. As part of a larger plan to capitalize on this opportunity, we commissioned a new biologics manufacturing plant during the year that became operational in FY18, and it'll support manufacturing of clinical as well as commercial batches for global markets. And the construction of our upcoming API manufacturing facility in Mangalore is making good progress, and we expect it to come in on plan and be operational in FY20. Once fully functional, it will signify a significant ramp up in our commercial scale manufacturing capacities. I think I mentioned it before on previous calls. We set up a US subsidiary, Syngene Inc., and that'll support better client interaction and being a little bit closer to a number of our clients in the US. We also strengthened our leadership team during the year with the appointment of Ashu Tandon and Sebi Chako to the roles of Chief Commercial Officer, Chief People Officer, respectively. So to sum it up, FY18 was a good year. We brought new clients to the fold, expanded the scope of work with existing ones, extended collaborations, successfully passed regulatory and compliance audits, and I think made the right investments under a well-thought-out CapEx plan and hired some of the best talent in the industry. So overall, a very good year. So that's it from my side in terms of summarizing. Let me hand over to our CFO, Mr. Chinappa. Chinny.
Thanks, Jonathan, and thanks everyone for joining this call. What I intend to cover over the next 10 minutes or so is to provide you a brief overview of the fourth quarter financial performance, follow that with a review of the full year results, and then move to a discussion on some of the moving parts within the P&L. As you can see from the press release, we've had a strong finish to the year, and FY18 recovered from a slow start to be a good year overall. That said, I do want to spend a bit of time walking you through the impact of the interest income, currency, and some one-off items that have impacted the P&L, as well as signpost to you the increasing impact we expect at the PAT level starting from FY19 from the unwinding of the tax SEZ tax holiday benefits in some parts of our business. I'll wrap it up with a discussion on our committed capex for the coming year and some guiding comments on the directional growth we expect for fiscal 2019. As you know, our policy is not to give a specific EPS or earnings guidance, but I do want to be helpful with giving some indication of the direction of travel on the key P&L line items. Revenue for the fourth quarter FY18 grew by 35% to 426 crores compared to 315 crores in the same quarter of last year. This was largely due to the strength of our development services vertical, which was supported with the commissioning of a biologics manufacturing plant. Our discovery services offering, particularly Discovery Biology, saw good traction too. Please also note there is the lower base effect as Q4 FY17 was down by about 8% on account of the fire incident. Adjusted for the impact of the fire incident, the total revenue growth for the quarter would be about 23%. This has shown steady improvement over the year, with growth rates improving from a low of 6% in Q1 to 10% in Q2 and 15% in Q3. In constant currency terms, our revenue growth is 3% higher. Average realization against the US dollar was about 64.9 compared to an average of 66.2 in the same quarter of the previous year. EBITDA for the fourth quarter was 146 crores. This is up 18% compared to 124 crores in the same quarter of last year. While profit after tax is up by 8% at 84 crores compared to 78 crores in the same quarter last year. EBITDA and PAT margins for the quarter 34 and 20% compared to a relatively high 39 and 25% respectively in Q4 FY17. Please note that Q4 FY17 profitability was very high and well above the historical average on account of high other income and lower income tax. During the quarter, we had recorded interest income of 17 crores. Associated with interest income are finance charges of 7 crores and income tax of 9 crores. Adjusted EBITDA and PAT margins, excluding impact of interest for Q4 FY18, is 32% and 19% respectively. Moving on to our cost elements, our material and power costs as a percentage of revenues have increased to 32% this quarter compared to 28% in Q4 FY17, owing to the shift in the sales mix and a higher pass-through expenses. Employee cost as a percentage of revenues is marginally down to 24% compared to 25% in Q4 FY17. During the quarter, we had 31 crores of forex gains compared to 16 crores in Q2 FY17. This has helped to negate the impact of rupee appreciation. The other expenses for the quarter are up by about 75%. This is largely linked to a one-off tax payment relating to previous years. Adjusted for tax payments, the other expenses have grown by 46% on account of expansion of our facilities and initiatives in business development, safety, and compliance. Now coming to the full year financial performance, we have reported total revenues of 1485 crores, which is a 17% growth over FY17. Full year FY18 revenues include a benefit of 47 crores from export incentive schemes of prior years that have been accounted in the current year based on certainty of realization. This has helped neutralize the 4% impact of currency appreciation for the full year. We have recorded an interest income of 62 crores as compared to 70 crores in FY17. As we move towards FY19 and beyond, we expect lower interest income benefits aligned with the increased capex towards the capacity expansion. EBITDA at 527 crores reflects 35% margins compared to 478 crores and 38% margin in FY17. Profit after tax at 305 crores compared with 267 crores in FY17, reflecting a 21% PAT margin. Now, if you adjust performance for the benefit of interest income, adjusted EBITDA is 31% and PAT at 20% compared to 32% and 22% respectively in FY17. Effective tax rate for the year is 18%. We continue to benefit from the tax incentives applicable to the special economic zones. However, we expect to see an increase in tax rates from FY19 onwards as some of the units come out of the tax holiday period. As regards CapEx, we have so far committed a total spend of 108 million against our ongoing 200 million CapEx program. This includes 75 million for expansion of facilities in Bangalore and another 33 million towards the upcoming API manufacturing facility in Mangalore, which we expect to be commissioned in FY20. During the year, during FY19, we expect to commit an additional 58 million from the total planned CapEx of 200 million and also commit approximately an additional 100 million towards supporting near-term growth. The net cash position as of March 31st, 2018 is 320 crores compared to 280 crores as at the end of last fiscal. Just an update on the S2 facility resumption and related insurance. The refurbishment activities are nearing completion, and as indicated earlier, we expect the facility to be operational during Q1 FY19, that's this quarter, April to June 2018. This will help us restore lost capacities. With regard to the damaged assets, we have so far received a total insurance claim of rupees 81 crores. The balance insurance proceeds are expected to be realized later in the year following the refurbishment of the facility. Forex, our hedging policy provides for some near-term protection against currency movements, and overall we do not see short-term currency movements impacting profits for FY19. Now moving to the directional outlook for FY19, the expansion of our business with some of our strategic clients including Amgen, BMS and GSK, along with the momentum in our discovery and development verticals, provides a strong platform for growth in FY19. Having said that, we expect total reported revenues in FY19 to come in a notch higher than the FY18 growth of 17%, despite headwinds in interest income and export incentives. Our Q4 margins is a good indicator for EBITDA margins in FY19. However, the twin effect of the increase in depreciation and income tax will impact PAT margins in FY19. I'd like to hand it back to the operator and happy to take any questions.
Sure. Thank you very much. We will now begin the question and answer session. Participants who wish to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Pashi Anand from Allegro. Please go ahead.
Yes, hi. Thank you for taking my question and congratulations on a good year. The first question I had was with relation to the whole biologics opportunity. If you look at the certain global players that have set up very large CMO facilities in hundreds of thousands of liters per year, and there's a lot of interest being generated in the market with relation to the large biologic CMO or biosimilar CMO opportunity. I just wanted your thoughts on, do we have any plans on setting up a very large-scale facility that can actually cater to the for requirements once the drug is actually being manufactured?
Hi, this is Manoj Nerurkar. I'll take that question. See, the large capacity that you talk about that has been set up by some of the biologics manufacturer CMOs across the world are mainly to cater to some of the biosimilars that were of high dose strengths of yesteryears. As you know, one of Syngene's main strengths is to play in the area of new molecules, and be those new molecules are small molecules or large molecules, biologics in this case. Now, if you look at our partners or our clients who really develop these large molecules, there are two important phenomena that are coming into picture, and those phenomena are the drugs are becoming more and more potent, one, and secondly, the titers, or drug or a protein produced, a biologic molecule produced per liter has really gone up. The impact of that is that the requirements in terms of facilities have really reduced from these large, 10,000 and 100,000 liter capacities to more manageable 2,000 liter single-use bioreactor kind of facilities. If you look at our clients and the kind of facilities that they are looking for, it's clearly in the range that we are playing in, which is 2,000 liter single-use bioreactor facilities with multiple trains. And looking at that trend, we believe, which is actually reinforced by our clients, is that the kind of facilities we have put together are more suitable for the type of work that we plan to do, either in development phase or in the commercial manufacturing phase.
Yeah, thanks, Manoj, for the summary there. Having got the premise of the question now, I think you're absolutely right. The state of the art's changed. Most of our clients would now view very large stainless steel, high volume capacity installations to be yesterday's technology. And actually the state of the art has moved to be these disposable, smaller trains. And to be frank, all you do if you want 10,000 litre scale is you string 5 of them together. And that gives you the sort of flexibility and still gives you fantastic sort of production quality and yields. So the state of the art's moved on, and what we've installed is what at least currently is considered to be right on the leading edge. So we're glad that we did that, and certainly we find that's the conversation we have with our clients. So thank you for the question.
No, thanks. That was very, very helpful. I had a second question with relation to the Mangalore SEZ. Just wanted to understand how should we look at the ramp-up of this facility? As in, once it's operational in FY20, would we still require approvals from various regulators, and be it approvals or contracts, would that be a barrier to ramp up of the facility, and over what period do we see this getting fully utilized?
Yeah, good question. I think you covered many of the dimensions, so you're thinking about it in the right way. And of course, I mean, it's a statement of the obvious, but absence of contracts would be a barrier to the ramp-up. So that really is a key thing. And we're out there starting that process now. I mean, we've still got quite a long way to go on the building construction phase of Mangalore. And of course, on the day we open it in FY20, it will be a brand new, high quality but empty factory, because you take time to build a book of business. I think I've signaled this in a couple of conference calls over the last year or so. Our experience and sort of intuition tells us that what's going to happen is clients will want to come and inspect your finished facility as part of their own due diligence. So I wouldn't expect a fast start once we open that factory up. But I would expect us to progress quite quickly after that, because they have to get comfortable, not just that you've got beautiful architectural drawings and blueprints, but you've actually built a high quality facility with your systems and processes. I think on the regulatory front, you're right, there will be a qualification period, but that's normal, I think, for opening any sort of infrastructure like that, and we have a good plan in place. Longer term, I think maybe one way that would help you model it is to think about it as a one-for-one asset turn. We've given you fairly good feel on the amount of capex we've put in there, so that'll give you a sense of the overall value capacity towards peak. an asset like that. And it takes 2 or 3 years at least to move up towards peak optimal utilization. So I think with all the moving parts in that sentence, you can triangulate and get yourself quite a nice revenue curve and model it out by my maths all the way out to 2023, 2024, which is a little bit longer than most analyst spreadsheets go. Hopefully that was helpful.
It was very helpful. Thank you so much for the answers.
Thank you. The next question is from the line of Nishant Chandra from Temasek. Please go ahead.
Yeah, hi. Thanks for taking my question. The first one is on just understanding the sharp increase in the cost of goods sold. Is there any non-recurring item in there in terms of to understand the increase in costs?
Okay, that was the first question. Was there a second question?
Yeah, there is a second one as well. I think the results document talked briefly about a proposed ESOP plan. Can you highlight that a bit further? And the third one, if I can slip that in, is Chini briefly touched upon $100 million support for growth of business. In what shape or form are you thinking of from a $100 million support perspective?
Okay, Chini, do you want to do the first and the third? Yeah. And I can make a comment around ESOPs in the papers.
Nishan, first, really to look at a gross margin, point towards adding material, power cost and staff cost. Look at income of operations, revenue from operations, less material and power cost, less staff cost to come to your gross margin.
Yep.
Overall, our gross margin has come off by 1%. And this is largely as indicated at the beginning of the year that we would be looking to increase investment into BD, safety and compliance. So that's is partly reflected in the increased staff cost. Okay. There is a spike in Q4 material cost. This is largely on account of the sales mix and also some pass-through expenses that we built to our clients.
Got it. Okay.
Third question.
Yeah, sorry. Yeah. So, additional 100 billion capex is really supporting near-term growth. So as we expand our business in discovery chemistry, discovery biology, we need to create additional infrastructure to support that growth. So that's where most of this 100 million is directed.
Okay. That's more like routine capex, right? Okay, understood.
Growth capex, but supporting with the expansion of our current.
And in terms of just the site of expansion, is it going to be in the current campus or is it going to be in a proposed new campus of sorts? Because the current campus is also getting full up, right?
Most of this would be in the current campus, but yes, we are looking at a new campus to expand some of our operations.
Okay, and that would be in Bangalore or in some other alternate location?
Most likely in alternate location. Once finalized, we will let you know.
Understood. Yeah.
Okay, and just on your ESOP question, the continuation of the policy that we've had over the last 5 or 6 years, we're an organization that I think believes in performance-related rewards, that if individuals or teams or departments or the whole company are successful, it's right that they should have the opportunity to share in that. It creates alignment with shareholder value creation. Yeah. And we've done that, I think, very successfully over the last 5, 6 years or so. We just have a procedural issue, which is the terms of our current ESOP scheme have been met, and we have to renew it if we want to keep in place that sort of alignment and incentive in the future. So we'll take a refresh of our scheme and take that to the shareholders at the AGM and seek their approval to do that. But the key thing I'd reiterate, we're a performance-led, performance-related, performance-rewarding culture. So it pays out of the upside is the point.
Yeah. May I step in one more question, if I can?
You could, but that takes you 2 questions to 5, which is very...
No, 2 to 4. Yeah, if I may. Sorry, just one point, which is on the 483 that was again briefly touched upon in your press release on the BAB facility. Can you provide a gist of the observations and what is the resolution path for that?
Yeah, we can. I'll look to Manoj to maybe give you a few comments on that. I mean, our general sense, and I hope that message came over, you never take any interaction with any of the regulators lightly. On this particular occasion, we think it's something that we have a very clear plan of action. We're a long way through implementing that already. It shouldn't, and we don't foresee any impact in our operations. We've responded back to the FDA. We're just awaiting the final exchange of paperwork with them to make sure we've closed it off satisfactorily. But I'm not sure if it really matters.
This was a study that was done on behalf of one of our clients a few years back. And when they looked at this one study, there was some analytical piece where they wanted us to do a little bit more than what we had originally agreed with the client. Was it 483 worthy observations? We have different thoughts. But, it's simple enough that we have already done the study. We have given all the data back to the agency, and we expect them to accept it and move forward. It's not something that has any impact on our ability to do any future studies or going to have any impact in terms of revenue as far as that particular vertical is concerned. So it's as simple as that.
Okay. Thanks, Manoj. Thanks, John. Thanks, Jenny.
Yeah.
Thank you. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity and good afternoon to all. Just checking on, Jenny mentioned about the sales mix and the pass-through and that too being one time. So, I mean, in terms of, what would have been the one-time impact so that we could help, it could help us, looking at fiscal 19 as well?
Just taking it all off with a bit is difficult, but as I indicated, if you're looking at modeling FY19, at the EBITDA margin level, Q4 is a good indicator.
But as you mentioned, it had one-time impact.
Yeah, so the material and power cost should be not lower, but compensated with higher staff cost.
Understood. Okay. And you also mentioned about the tax rate with the benefits of SEZ coming down. So would it be like a couple of basis points, 100 basis points, or how much? I mean, just indicatively.
Yes, this could be within 100 to 200 basis points impact on account of higher taxation.
Understood. Fair enough. And in terms of business momentum, clearly you have these big anchor clients adding up. So just trying to understand, you did give some, color on how fiscal 19 would look at, which is a little better than what you did in fiscal 18. Just trying to understand that, if we just look at 3-year picture, would this kind of growth momentum fair to, draw for next 3 years?
Oh, thank you, Prakash. It's a fantastic question. It demonstrates yet again that when we have our policy of not giving guidance but helpful directional comments for the coming year, somebody's always going to add an extra couple of years onto it. But I'm going to resist the temptation to give you 3-year guidance. I thought we were being quite helpful, giving you a nice picture of the moving parts out for FY19, but take it out a little bit further, actually. So think about, what this business looks like over the next 5 years or so. And you can see that we've got a strong core with our discovery services business, with discovery biology and discovery chemistry and all of the associated services that we wrap around those. When we integrate those together, we create real value for our clients, and often that then culminates in things like the dedicated centres model. So the vast majority of sort of Syngene's history is in that, scientists in the lab
innovating, high-quality science, but it's a discovery service engine, really. What you'll see over the next 5 years, and this fourth quarter just gone is maybe one of the starting points of it, is adding in that manufacturing business alongside it. Now they're beautifully synergistic. They involve us having strong, deep relationships with exactly the same client groups. But it's a different business and a different business model. And I think that is one of the opportunities where Syngene goes from one powerful engine to two engines. And I think that's quite important as you look out over the next 5 years, that you understand when that starts to impact the P&L. You can see it starting and building momentum now from a small base in biologics. And then FY20 onwards, and we had that earlier question on, what's the sort of ramp up you can expect on Mangalore, and I think I gave you everything you need to triangulate into that. The combination of those two should give you a good sense of that longer term. But, you'll forgive me if I don't give you a specific 3 years revenue number.
No, sure, thanks, that's helpful. And lastly, on the capex side, just missed the comment. So if I gather it correct, so of the $200 million, $58 million is remaining, and which would be invested in next 2 years, and you're planning additional $100 million. Is that right?
No, your maths are 200 million minus 108 million already invested. 58 million is the number for FY19. The delta between all of those, when you add them up, will be what spills over into FY20. And yeah, you get that? You follow the maths?
Yeah. So there is no additional $100 million, is what I understood.
Yes. There is an additional 100 million, and this would be towards supporting expansion of our business, really the discovery services, additional labs to support the expansion of discovery chemistry, discovery biology, and some expansion of our chemical facility.
Understood. And this would be over how many years, sir?
Committed this year would be spent largely between this year and next year.
Okay. I have more questions. I'll join back the queue. Thank you.
Thank you. The next question is from the line of Vipul Shah from Sumangalam Investments. Please go ahead.
Hi, good afternoon, sir. That facility which was damaged by fire is coming back this quarter. So what type of additional revenue we can expect from quarter 2 onwards from that particular facility?
Yeah, you're right on your timing. In fact, actually, I did a walk around that facility this morning, and it's looking good. One or two things just to do in terms of the final fixes and fittings, but we should be able to start to reoccupy that building and getting it up to speed operationally from next month. I think one of the things that you need to think about is when we lost the infrastructure back in December 2016, it caused quite a space crunch across our campus. So, we've really relied on the excellence and I think the patience of a large number of our scientific teams who've coped admirably over the last year under what would have been some quite cramped conditions. So certainly the first wave of the S2 facility coming back online is just moving us back into a more normal operating environment, and that will allow us to sort of decompress across the campus. Beyond that, I would just wrap up the driver that you'll get from S2 into the normal business growth that you would see at Syngene, and I think Chinny's given you some fairly good directional comments on where we see that being in FY19.
Okay, sir. Thank you. All the best.
Thank you.
Thank you. Next question is from Surya Patra from Phillip Capital. Please go ahead.
Yeah, thank you. Thanks for this opportunity. So just on the Merck alliance, is it a biologic service alliance that we have been having with Merck, and is it renewal for 1 year, or it's been the kind of a renewal that happening every year, or how is it?
Well, Surya, the work that we are doing with Merck has been, we have been working with Merck for last almost 18, 20 plus years. And this is a collaboration on mostly discovery of biologics rather than biologics development. It's not related to the plant that we just operationalize. So it's more of a discovery type of work that we continue to do and expand when it comes to collaboration with Merck.
So, Manoj, I just wanted to know that, whatever the discovery biologic activity that we are offering, service offering that we are currently having, so that will fall under the biologic services only, right?
No, that falls under discovery services.
Okay, in the CRO activities that will fall in.
All these are CRO activities. If you remember, we divide our business in three verticals, right? One is dedicated centers, which are our strategic collaborations with companies like BMS, Amgen, and so on. The second vertical is a discovery services vertical. So this particular falls under that vertical. And the third one is development and manufacturing services, under which the biologics falls under. So this falls under the middle one, discovery services, which includes discovery biology.
Okay. So now, as we have indicated that this quarter onwards, we have started seeing some meaningful ramp up in the biologic services front. So, how much or what percentage of the revenue that so far we have achieved, and what is the scalability that we are currently visualizing on that front? If you can share some idea on that.
So I'll talk about the scalability of the business. The biologics business is, as I said, falls under development and manufacturing services. This is a plant that we have just inaugurated, and we are looking at filling up that capacity. So far, progress has been excellent because we are, especially in this quarter, and our visibility for the future looks quite good as far as the biologics is concerned. But specific guidance on how much percent or contribution to the revenue comes from biologics is something we don't give vertical by vertical.
Okay, fine. So just one more question on the BAV services front, whether this is entirely a kind of what is the kind of a quantum of revenue that we should be generating out of the BAV services as of now? It should be a minimal one, I believe. Is that correct? Or
low single digit.
Yeah, Surya, it's low single digit.
Yeah, okay. Thank you.
Thank you very much. Due to time constraints, we'll take that as the last question. I would now like to hand the conference back to Ms. Chandralekha Nair for closing comments.
Thank you everyone for joining today's call. Hope we have answered all your queries. In case if you have any questions, please feel free to get in touch with me. Thank you. Have a good evening.
Thank you very much. On behalf